The system most people trust to protect money is quietly failing without alarms, votes, or public explanations. Right now, decisions shaping mortgages, savings, jobs, and currencies are being made far from public sight. This story begins with a disturbing question. Why do central banks grow silent before global pain begins? Interest rates don't simply move. They are guided, timed, and coordinated behind closed doors. When officials stop speaking clearly, markets don't relax, they prepare for something worse. Central banks are presented as dull, technical institutions, but that image hides something far more powerful. Behind every calm press conference exists another layer never meant for public scrutiny. Private calls, emergency meetings, and unrecorded discussions shape the global cost of money itself. This is where the story turns dark because silence becomes a tool, not an accident. The origins of this shadow coordination trace back to moments of panic, not peaceful planning. After global wars shattered currencies, governments demanded stability at any cost. Central banks promised order, but built secrecy into the foundation of cooperation. Emergency back channels were created to act faster than public debate ever could. First, secrecy felt justified, even necessary, during moments of existential financial collapse. But this single detail changes everything. Those emergency tools never disappeared afterward. Instead, secrecy became normalized, routine, and eventually expected. As markets globalized, central banks began meeting more frequently without public oversight. The most powerful of these gatherings occur quietly in neutral locations, far from cameras. The Bank for International Settlements hosts meetings that shape monetary policy worldwide. No transcripts exist, no recordings released, no accountability mechanisms activated. Officials insist nothing important happens there, yet patterns reveal something very different. Interest rates across nations move together, even when economic conditions clearly diverge. Inflation spikes trigger synchronized responses, not independent national decisions. This coordination isn't coincidence, it's deliberate alignment. And this part was quietly erased from history. Secrecy removes responsibility when outcomes fail. When no one officially decides, no one can officially be blamed. Financial disasters rarely begin publicly, they incubate privately. Delayed action, hidden consensus, and silent agreements transform risk into catastrophe. The 2008 crisis exposed how deep this coordination truly ran. Trillions were created digitally in days without public approval or legislative debate. Markets were saved, but trust was quietly mortgaged. Dangerous precedent was established and never reversed. If central banks could coordinate secretly to stop collapse, they could shape outcomes too. This is where the system crossed from protection into power. After 2008, transparency didn't increase. It vanished further, language became vague, statements carefully ambiguous, intentions deliberately unclear. Markets learned to decode hints rather than facts. Meanwhile, asset prices exploded while wages stagnated. Inequality surged, yet central banks insisted neutrality. But neutrality becomes fiction when silence consistently benefits capital holders first. The breaking point arrived without sirens, not crashes, but synchronized, tightening. Rate hikes rolled across continents within weeks, not years. Housing froze, debt costs exploded, and weaker economies began collapsing. Still, the meetings continued quietly, shielded from public view. No one explained why the pain was globally synchronized. No one admitted coordination, and no one asked permission. This fallout changes democracy itself. When monetary policy moves in unison, governments lose real autonomy. Elected leaders react, they don't decide. Voters blame politicians who no longer control outcomes. Democracy erodes silently, not through coups, but irrelevance. Failed reforms reveal the system's self-protection. Transparency is dismissed as dangerous. Oversight is labeled interference. Complexity becomes camouflage against accountability. Silence stops being suspicious and becomes standard procedure. Modern technology magnifies this power exponentially. Algorithms react in milliseconds to whispered signals. Markets move before explanations ever arrive. Central banks now influence not just rates, but access to money itself. Digital currencies and programmable money raise stakes dramatically. Silent decision can now freeze, redirect, or restrict entire populations. This is no longer theoretical power. So what does this mean for you? First, interest rates are political choices disguised as technical necessities. Second, secrecy favors those closest to financial power. Third, systems built to prevent panic also prevent accountability. The danger isn't malevolence, it's unchecked authority. History shows systems don't collapse from panic alone. They collapse when people realize they were never included. Every synchronized decision raises the same unanswered question. What was agreed upon before the announcement was ever written? If decisions shaping your future happen in darkness, trust eventually breaks. And broken trust cannot be printed, borrowed, or coordinated back into existence. The most dangerous financial decisions are rarely announced publicly. They are finalized quietly long before consequences become visible. If this made you uncomfortable, it should. Because silence is never neutral when power is involved. Stay alert, question coordination, and never assume transparency still exists.